Hey guys, I hope you're going to enjoy this upcoming interview with Peter Schiff. Before we dive in, I wanted to let you know that I was having some technical issues with Zoom, and this means the camera is going to be cutting to me when Peter's talking way more than it should. Besides that, there's no other issues. I'm sure you're going to enjoy it, so without further ado, here's Peter Schiff. Hello everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today's guest is the chief economist and global strategist at Euro Pacific Asset Management and the host of the Peter Schiff Show. Peter Schiff, it's great to have you on.
Well, thanks, Jesse, for inviting me onto your podcast.
Well, I'm very happy you're here. I've wanted to have you on since I started this show, so it's a great honor. I'd like to start off, like I do with all first-time guests on the show, with the origin story. So take us back to when you first discovered investing and how that road led you to where you are today.
Well, I've been investing for a long time. I think my first investment was I got my bar mitzvah money back in the 1970s, mid-70s, and I used it to buy some gold. And then the price of gold went up, and I was able to sell it to buy my first car. So I made a little money there. But I started my career in investing after I got out of college. I went to UC Berkeley, and kind of my first jobs out of school were related to commodity futures, options. Then I moved into securities, stocks, bonds, got all the required now FINRA licenses. Eventually started my own broker-dealer. And I built it up over the years, eventually sold it, moved to Puerto Rico. I retained ownership of a RIA that I had also established, Registered Investment Advisory, that was actually based in California. Now it's here in Puerto Rico where I live. But I rose to a bit of fame for a lot of the forecasts I made, both in writing and on numerous cable television programs back in the early 2000s, or 2005, 6, 7. I was regularly appearing on CNBC, Fox News, Fox Business, Bloomberg, CNN, just talking about the financial crisis that I saw coming, and the bubble in the housing market and the problems in subprime, and pretty much predicting everything that happened in 2008 with respect to the banks and real estate and the economy and all that. So those accurate predictions gained me a bit of fame. I also authored 4 New York Times best-selling books. I haven't written one in a while, but back then I was a little bit more prolific in my writing. And so I developed the following there. Eventually had a failed Senate campaign in 2010 in my then home state of Connecticut. But after that was over, I started a daily talk radio show, did that for a few years. Now do a podcast, which is available on schiffradio.com, on my YouTube channel, Peter Schiff. But my main business is still asset management. Along the way, though, I did start a company called Schiff Gold, which sells gold and silver physical for delivery. So I'm still involved there. But again, mainly the asset management of portfolios. My asset management company manages a family of funds. We have 5 mutual funds that are all doing extremely well. They've been winning awards recently for top performance. I expect that to continue and actually improve as my thesis continues to play out in the move from momentum into value, from money-losing companies to dividend-paying companies, from the U.S. to foreign, from developed to emerging markets. I think these trends have a long way to play out. And so I think our outperformance is going to continue and accelerate. And we also manage individual accounts, separately managed accounts for individuals through that registered investment advisor as well. I still maintain ties to the broker-dealer I started that I sold. So I still help out there with the strategies that the brokers there are following.
Great. Well, I'd like to discuss the US dollar with you to kick things off, because its status as the world reserve currency seems to be threatened at the moment. Kenya has recently signed a deal with Saudi Arabia and the UAE to buy oil with Kenyan shillings. Yuan is now being used for the first time in an LNG trade internationally. Xi and Putin seem to be getting closer than ever and have established an agreement to use both the yuan and ruble for energy transactions. And even CNN is musing about the possible consequences of de-dollarization. So how much of this is hyperbole and how much of this is something you actually could see coming to pass?
Well, none of it is hyperbole, and all of it will come to pass. The only thing that's surprising about the dollar's reserve status is that it still has it. Despite everything that we've done, we haven't lost that privilege. But I think the current financial crisis, which just started, is going to ultimately deliver the death blow to that status. I think the amount of inflation that the Federal Reserve is going to unleash in order to try to counteract this financial crisis. I mean, people are still reluctant to call it a financial crisis. That's exactly what it is, except it's bigger in scale and it's going to be far more impactful than the 2008 crisis. And it's probably going to result in even more aggressive and reckless monetary and fiscal policy. And this time, it's going to take the dollar's reserve status down with it. So I think that's going to really complicate things here in the U.S. because that's going to send inflation much, much higher and American standards of living much lower.
So is there actually a risk of hyperinflation occurring with the U.S. dollar? I mean, you're of the view that inflation will go higher. We've seen the Fed pull back to a 25 basis point hike in the face of a crisis in the banking sector. And many are speculating that rate hikes are done. We're going to return to rate cuts and full-on QE. So I know you see that driving inflation much higher, as I've heard you mention before in other interviews as well. Is there an actual risk of hyperinflation of the US dollar here?
Well, I mean, there's always a risk for every country that issues a fiat currency. Hyperinflation is always a risk. The question is, how high is the probability? Because not all risks end up, becoming, to fruition. So we could avoid it. But I think the risk is a lot higher now than it's ever been. And in order to avoid that outcome, it's going to require some very difficult political decisions and choices that need to be made to avert that outcome. But I think even if we manage to avoid hyperinflation, something like Zimbabwe or, Weimar Republic, Germany, some of the really big examples where, you need wheelbarrows full of money, to buy a pack of gum or something like that. It's a possibility. It's hard to handicap how high a probability, but I do think that we're going to have very high inflation for many years to come. I mean, elevated double-digit inflation, and where the first digit may not be a 1, it could be larger than a 1, right? So it's going to be very substantial inflation, even if it doesn't technically qualify as hyperinflation. But that's not, ruled out. So you have to be vigilant and be prepared because that worst case scenario may in fact be the scenario that ends up playing out.
So what do you think the fate of the banking sector in the U.S. is going to be as we've seen this banking crisis emerge? Are we looking at wealth being consolidated in the too big to fail banks, wiping out the regional banking sector potentially as a result? And if so, what would that mean for the economy and the stock market?
Well, first of all, thanks to the Fed's policies as well as government regulation and the moral hazards that it creates, the entire banking system is completely insolvent, including the too big to fail banks. All those banks would fail if the government stepped out of the way. But the reason our financial system is so vulnerable and so leveraged and insolvent is because of government. And now you have politicians trying to claim that the problems for Silicon Valley Bank or Signature Bank were the result of a lack of regulation or of deregulation, when in fact the opposite is true. It was excessive regulation that is the reason that the banks got into this predicament in the first place. And of course, without the Fed holding interest rates so low for so long, they wouldn't have even been able to have loaded up their balance sheet with all this debt. But all the banks have done this. I mean, think about the mortgage market. How many Americans over the last 5 or 10 years have successfully refinanced their mortgages to have rates in the 3s? That is a huge gain for the borrower, but that comes at an enormous loss for the lender, who is now stuck with that low yielding paper in a much higher and rising interest rate environment. So all the banks are going to lose a fortune as a result of owning these mortgages, and they will fail unless the governments bail them out by creating more inflation, which is ultimately how the bailouts are paid for. In fact, the Fed has already returned to quantitative easing, whether they want to call it that or not, but the balance sheet is up about $400 billion since this financial crisis began, and it's going to get a lot bigger in order for the Fed to postpone the pain of the crisis and socialize it into a different form of pain, which will be higher prices, because that is what's the substitute. So on the one hand, the government says, don't worry about your bank account, we're going to guarantee it. But on the other hand, you now have to worry about the value of the money that's deposited in your bank, because even though the bank might not fail and you won't lose your money, when you go to spend your money, you won't be able to buy very much because your money is going to lose its purchasing power.
Well, let's talk gold here, because all of this madness does seem to be the perfect storm for gold. Are we going to see more of a flight to gold and perhaps silver as well as all of this unfolds? I know myself, I purchased gold as soon as I saw this starting to happen, but it traditionally been a good hedge against inflation or potential hyperinflation. What are your thoughts there?
Oh, yeah, there's no question that just like there's going to be a run on the banks, meaning people are trying to get their money out of the banks, they're going to be running to put it into gold, because no money is safe now in the bank, because either your bank is going to fail and you will lose your money, or your bank won't fail because the government bails it out and your money will lose its purchasing power. So either way, you should withdraw your money now, but don't stick it under your mattress, because it's going to lose purchasing power there too. You've got to convert it to real money. You've got to turn it into gold. Now, if banks could offer you a high enough rate of interest to offset the inflation, then that might be an incentive to leave the money in the bank. But the banks can't do that because they can't afford it, because they're broke, because they've already locked up all their deposits in long-term, low-yielding mortgages and treasuries. So they can't pay you enough to offset the loss of inflation, but they can't stop you from withdrawing your money. The problem is they don't have the money because the money has been lost. That's what happened to Silicon Valley Bank or Signature Bank. So as more people rush to withdraw their money from banks and use it to buy gold, the Federal Reserve is going to have to print more money to enable those withdrawals, which is going to create even more inflation, which is going to accelerate the appeal of gold and cause even more people to deplete their bank accounts to buy gold. And then it's a vicious circle of, collapsing banks and runaway inflation.
Will we ever see a return to a gold standard, in your view? Will we ever see gold and silver being used as a form of currency? It's every gold bug's dream. Could maybe the emerging BRICS nations' currency be backed by gold? Or is there some other way that you could see us returning to a gold standard at some point?
No, we will absolutely return to a gold standard. I mean, a gold standard has been the monetary system that has dominated through most of recorded human history. And I don't think that that's changed. I think we've temporarily experimented with fiat currency. The experiment is going to end in disaster, and it will prompt a return to what works, and that is gold. And whether it's governments or the private sector that lead the way, ultimately, that's where we're going to go. And we don't need governments to remonetize gold. The private sector can do it all by itself. In fact, gold was money in the private sector before it became money in the public sector. It became money for the kings because that was the money that everybody wanted. That was, if you wanted to pay your guards, you needed to pay them in money that they could use to buy food. And the farmer wanted gold. And so that's what the kings collected in taxes. They collected gold so they could pay their soldiers, right? But I think what would happen now is private enterprises, private businesses, whether it's a bank or any other institution, doesn't even have to be a financial institution, but it has to be capable of holding custody of gold. It can then digitize, tokenize that gold, put it on a blockchain or other form, and allow individuals to own those tokens and then transact in them on the internet instantaneously for a low cost. They can price goods and services in grams of gold. They can pay for and be paid in grams of gold, and gold can circulate easily around the globe as money, as a unit of account, as a medium of exchange, and as a store of value. And so I think we're headed in that direction. As far as what the Chinese may do, to the extent that they may decide that they want to back their currency by gold, make it redeemable into gold, I think that would be a very prudent move on their part. If they're interested in having the dominant currency in the world, that would be a way to secure that position.
I touched earlier, and as you mentioned there, China, and as well as Xi and Putin getting closer. I wonder from a geopolitical perspective if you see us entering a multipolar world, and if you see the United States potentially no longer being the dominant economy. Is the power shifting, and what would that mean for markets?
Well, that's clear. I mean, the power has been shifting for quite some time. And if you look at the relationship between the United States and China, China is clearly the rising power, and we are the declining power. China enjoys an enormous trade surplus with the United States. China has the industrial capacity that we lack, that we lost over the years. So the real production and wealth creation is taking place over there. And all we're doing is buying what they produce and borrowing the money they save to pay for it. So I think we have this phony economy that has been propped up by inflation and cheap debt, and it's in the process of collapsing. And when the dollar loses its reserve status, that'll be the final nail in the coffin. And I think the American standard of living is going to plunge because the dollar is going to collapse and prices are going to soar. And we're not going to be able to import what the rest of the world produces. Now, the rest of the world, if they don't export their production to the United States, well, they're going to have more for themselves. So Americans are going to have to make do with less, but the rest of the world is going to suddenly find that they have a lot more. And so while our standard of living goes down outside the United States, particularly in the emerging markets, the standards of living are going to go way up.
Well, that's a great segue because I want to touch on emerging markets here. I know that's part of your strategy at Euro Pacific, and I'm wondering if there's any parts of the world right now you've identified with less inherent risk in the system than the US, and if so, what would those be? And do you think investors should overall be considering investment options in international and emerging markets?
Yeah, well, first of all, I think almost all economies have less risk than the United States, whether they're developed or developing. The United States is unique in the enormity of the risk, especially the risks that very few people perceive. So I think that, you're in much better shape if you avoid the US market, bonds, stocks, just kind of totally, and focus internationally where I think the risks are there. They're just not as severe. And I think there's a lot more upside. So in exchange for accepting that risk, I think you have a disproportionate upside potential. Whereas the United States, I think the upside is very limited and the downside is quite substantial, especially when you view it from the prism of, let's say, gold, real money, as far as how much value US assets may in fact lose if you price those assets in gold. You can't simply look at what the price of stocks would be or bonds in dollars if you have a moving target because the dollar is collapsing. And so it's hard to measure the value of something when your ruler is constantly shrinking, right? So you're not going to get a good result. So I think looking abroad, investing abroad, and in foreign stocks, dividend-paying value stocks, I mean, that's what you want to do. That strategy has been paying off. We substantially outperformed the U.S. markets last year with positive returns in our dividend payer strategy and our value strategies, even despite the strong dollar, because these were all international stocks that managed to, close the year, in the black, while the Nasdaq was down 30%, and smaller declines in the S&P and Dow, but still substantial declines.
And are there any countries in particular you could perhaps point out to us that may benefit in the years ahead? I've heard some people talk about India and Brazil offering opportunity. Is there any countries that are on your radar right now?
I think they will benefit. I think commodity prices are headed much higher, and that would benefit Brazil. There are a lot of other things that could benefit Brazil. I don't know if they'll happen. But I have some investments in Brazil because I believe that the commodity boom is still young and has a long way to go. And I think Brazil will benefit from that. And they're not the only country that will, but they're one. But Southeast Asia in general, I think, is going to do extremely well as a result. I mean, the countries that are producing the most and saving the most are the ones that are in the best position to prosper during the coming decade. It's a country that is dependent on debt and consumer spending for its GDP growth. Countries like that, which of course, the United States is the poster child for that kind of a dysfunctional economy, those economies are in a lot of trouble.
I'd like to get your thoughts on silver here, because in precious metals bull markets, at least initially, silver tends to outperform gold. Do you see that scenario playing out again? And what are your thoughts on the growing use of silver as an industrial metal used in solar panels and other forms of green technology?
Yeah, I think it's quite probable that silver will outperform gold, especially as we get to the latter part of the bull market in precious metals, which I think still has a long way to go. And yes, I think that there are new uses for silver. At one point, silver was big in photography, and digital photography kind of temporarily put an end to that. So you didn't need as much silver for photography, but there's all sorts of new uses that are being discovered for silver that will more than supplant the fact that it's not used in photography to the degree that it was. And so I think, for both industrial and precious metal purposes, I think you're going to see significantly higher silver prices.
And final question here. Besides the precious metals, are there any other commodities in particular that you're bullish on, either as a potential safe haven against inflation or something that presents opportunities for profit in the years ahead?
Well, I mean, I'm pretty bullish across the entire spectrum of commodities. If you're going to have very high inflation, then all those commodities are going to go up in price in relation to the currency that's going down in value. But, obviously there are some classes that I think might do better than others. I think that the agricultural commodities can be particularly strong. And some of the industrial metals, will do well. You got and energy, but that's pretty much the whole gamut. The big commodities. But I think as the emerging market consumer really comes into his own, as the dollar crashes and these currencies rise, and now you have 2 billion people that all of a sudden can buy a lot more stuff than they could before. I think that the nature of what they buy is going to be far more commodity intensive than what Americans used to buy before they went broke. So I think that this emerging market boom is going to be very bullish for commodities across the board. And so I think they should be owned. You don't have to necessarily own the commodity, like have a commodity futures account and just buy some soybeans or some crude oil. You can buy businesses that operate in industries that will benefit from rising commodity prices, in particular, agriculture commodities, if you want that exposure. So you can own a piece of a business that makes more money when agriculture is booming, when prices are rising. So it's a good strategy. Or there are certain currencies that are related to certain economies that will get a boost to their GDP from improvements in terms of trade as a result of higher commodity prices because they export a lot of commodities. So you could just own businesses in economies that will benefit from a rising commodity price because it will increase the wealth of everybody that's living in those countries and increase the relative purchasing power of their currencies. And you're looking at countries, let's say like Australia, that would benefit from that. And Brazil was one that would benefit. Canada has a lot of commodities. The United States too has some commodities, but the problem is we have a lot of other problems that offset the benefits that we get from commodities.
Well, thank you so much for joining us today, Peter. Really appreciated it. For those who want to learn more, could you fill us in on Euro Pacific Asset Management, the Peter Schiff Show, and anywhere you want to direct people online?
Oh, absolutely. That's my pleasure. So Euro Pacific Asset Management, again, that is my asset management company. It is a SEC registered investment advisor, and we work with individual customers. We manage portfolios that we build. I have a team of portfolio managers that here working with me. And so if you're interested in having my team and myself manage a portfolio that you have, and maybe you currently have it with another investment advisor or brokerage firm, or maybe you're doing it yourself, but you think we could do a better job, which I believe we can, you could become a client of my registered investment advisor. Contact their representatives. You can see the website, europac.com, above my shoulder. You go to the website, there's an 800 number that you can call if you would prefer to talk to an advisor about the strategies and how they may or may not fit into your overall investment plan and whether or not they're suitable for you. So you got that. Then if you want some physical precious metals, which everybody should have some, you could contact Schiff Gold, just my last name, gold.com, and talk to the representatives there and get yourself some gold and silver before buying gold and silver costs a lot more money, or a lot more, better reserve notes that are going to lose value. And make a habit of following me on social media. I've got almost 950,000 Twitter followers, so hopefully I'll crack the million level this year. I put out a lot of interesting tweets. In fact, I just highlighted one yesterday where I was watching these Senate hearings, and the senator was asking, or one of the senators was asking this guy from the FDIC, hey, your stress tests were bogus because you only tested for falling interest rates. Why didn't you stress test for rising interest rates? And I pointed to a tweet that I did 3 years ago in which I said the exact same thing. I said these stress tests are meaningless because they're not testing for what's actually going to happen. Under their worst case scenario, they're assuming that interest rates fall. No, the worst case scenario is that they rise because the banks are going to be very vulnerable to rising interest rates and rising inflation. And I hit the nail on the head on Twitter. So the people following me on Twitter are a lot more informed than the people who are relying on information from the Fed or anything in the mainstream media. So follow me on Twitter. I'm also on Instagram, Facebook, TikTok. I mean, we'll see how much longer Americans enjoy the freedom of being able to access TikTok. We'll see. But I'm there for now. So follow me there and make a habit of listening to my podcast. I do 2 to 3 a week in general on schiffradio.com. And you can also, if you prefer to watch me as opposed to just listen, you can go to my YouTube channel, and there's video. And I do these the podcasts on YouTube, and you could watch them, listen to them, and share them with your friends. Make sure and subscribe to my YouTube channel. I've got about 540,000 subscribers there, so a lot further to go to get to 1 million. But I have a feeling that by the time this financial crisis is over, I'll have more than 1 million.
Awesome. Well, I'll put links to all of that in the description below. It was great having you on, and hopefully we can get you on again in the future for an update.
Sure. Take care.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.